another quick question. I'm sorry that came in. Under the signature tools, you mentioned the ones you covered: stock repair, stock insurance, and you looked at the strike of pain and the long option finder. What are the other ones? Okay. Jim, the volatility skew tool under the signature tools. This is just similar to, not similar to the conversation that we've had, but you'll be able to see it quickly. We were using Avis, right? That was CAR, if I'm not mistaken. And let's go out 1 week. And what I'm going to do is what's called the strike skew. And we're going to look at all strikes. So what is this going to show us is what you may have referred to as, is there a volatility skew or volatility smile? I can't tell what the heck's going on with this one. This is all over the map. What we're looking at here is the blue line is our put implied volatility, and the red line is the call implied volatilities. And this is for every strike, as you see, going through the different ones, $86, $87, $88 strike differences. You got the 90 to 100 here. But the different IVs between the calls and the puts. So people might commonly look for something where they're looking for something that starts off near term high and then goes down. It says, oh, this is more of an indication of perhaps a bullish indication, or they're looking for over time the volatility smile. I have not found a consistent correlation between most things I've read about the volatility skew and volatility smile. Maybe 60% of the time, if that, it pans out like you're thinking, but it's in constant flux based on market conditions, news. I'm looking at something. We'll take a look at the time skew in a moment, but this is just 1 week out in time looking at this. And you almost see kind of a smile on the calls going up to the 120 strike, or it's more of a skew on the puts. Does that indicate bullish or bearish? Not necessarily. Okay. Just means that maybe the out of the money puts aren't really trading, so the implied volatility is out of whack because of wide bid-ask spread. Same thing with the out of the money calls, up to 120. Is Davis going to hit 120 in a week? Probably not. Okay. So, you're probably looking at some weird prices there, bid-ask spreads, which affect the implied volatility calculation. Now, the time skew. This is across time. And this is, what some people do. So we're going to select a strike, and we're going to stay with the 83 at the money strike here. And what we see here makes perfect sense, doesn't it? This is starting to make me nervous about what we said earlier. Why is that? This rise up here at the 83 strike, the highest implied volatility is here, right around where we were looking, wasn't it? That 11-1 target. But we were told, it's unconfirmed, but the expectation, probably because Avis reported their last earnings at around August 10th, August 11th. So without a confirmation yet of when their earnings are going to be released, I'd expect the highest bump in implied volatility to be here. But this might be projecting that 11-1, there is something more that's going on. It might be that the expected earnings are coming out at that time, or they said the earnings are expected between November 1st through November 5th, or November 1st through November 8th, but they haven't given a confirmation. But there is a lot of push. And of course, we have the election here. Well, it's probably closer to here, but yeah, we have the election here as well. But this is all right before it on about 11-1 or 10-31. That's where the highest IV is. It makes sense it'd be 11-1 because those were the options that just matched our criteria, looking for that higher implied volatility in that covered call screen. So something is going on here. There is some event with Avis coming up, going on here, closer to the 1st of November. That's why they came up in that search we created for Terry. But that's what it's doing. So is this a bullish or bearish indicator? Well, it's not giving you a time skew of a smile. This is sort of a skew, but clearly everything is pointing to the high IV right there for November 1st for Avis. Let's, now that we've had the earnings come out, let's take a look at Tesla. So this is the implied volatility of the at-the-money 83 strike options for Avis for every expiration going forward out in time. Not far out in time, the next 10, 15 expirations. Let's look, as I mentioned, Tesla. 270, we'll keep the at-the-money strike. We just had the earnings. So now you see something completely different, don't you? This one here at 11.8. Why is that implied volatility so high at 11.8 if Tesla just had its earnings a day or, the other day? What happens between now and 11.8? The election, right? So that's why there's still a spike there up to 0.65, and then we peter out. Even going out to 2027, right? This one's a little bit longer here. More expiration dates available for Tesla. But you're going in this time frame here. So we've got out to January, and then going all the way out to 2027. It's pretty mid-range. After that last earnings, fears have probably calmed down a little bit. Of course, again, this is in flux. This is going to change with market conditions. If new events happen in the global conflicts we mentioned earlier in the presentation, we might see all the implied volatilities move up. And you might see a bump here, shorter time frame out in time into 2025, and then a falling off. Like, hey, in the next 3 months, we're going to be really scared, but then everything's going to maybe just go back to normal as the market does, hopefully, knock on wood. But two, subtly different ones, but this one's vastly pointing to the election. Avis was inflated due to something coming up at 11.1. I'm pretty sure it's got to be earnings are going to be confirmed very soon, somewhere around 11.1 or 11.2. That's just what it's telling me based on that. Why is that spike in implied volatility there on 11.1 and then Avis petered out? But that's what this is showing you. Strike skew. Why would I use strike skew? The strike skew is commonly just used, I know I'm going shorter term, I'm going 14 days out, or if I want to just be 10 strikes out of the money, what does my volatility look like? Am I looking for that smile? Am I looking for that skew? I personally don't use it that way. I use the time skew more frequently. Why do I use the time skew? Because I do this in my searches for this strategy anyway, but when I'm doing a diagonal calendar spread, what some people might refer to as a poor man's covered call. I hate using that term. Many of you know why I hate using that term. We talk about it in some of our discussions. But I'm buying an in-the-money call and selling at or out of the money near-term calls against it. Like a poor man's covered call, of course, but if you do the wrong structure, you could get this setup where you have an upper and lower break even because you're not structured correctly. Remember, in a covered call, hey, if it's above my strike price, I just make that 3% return. If you set up the calendar spread wrong, the diagonal calendar spread or diagonal calendar spread or poor man's covered call wrong, you could actually lose twice even though the stock is going in the direction you anticipated. This is a bullish position. So what do I want? I'm selling near term, so just like Terry mentioned earlier, I want good bang for the buck. I want a higher implied volatility on the options I'm selling near term than what I'm buying maybe a year out, 6 months, or 8 months out in time. Now, in the calendar spread, I can set that up, of course. You have the IV ratio of the short option to the long option. I want that to be greater than 1. Just like the delta ratio, I'd use as well in the calendar spread, but I wouldn't necessarily use a delta ratio in something like a bear put credit spread or bull put credit spread. That's not what I'm sorry, bear put debit spread or a bull put credit spread. That's not what I'm looking for in my comparisons personally, but it's there to use if you want to. And I'm sorry, so that's what the volatility skew tool is. This is how I use it for that one strategy. The strike skew, again, investors looking for that, as I mentioned, that skew or that smile. There's a good smile on the puts, right? What is that implying? Is it implying bullish or bearish movement? Well, sometimes you talk to people and they say it's bullish. Sometimes you talk to people and they say it's bearish, depending on which one has the more pronounced smile. Or if both of them have a more pronounced smile, it means this and this. But again, my experience has shown that's only accurate maybe like 55% of the time, 60% of the time at best. Okay. But that's, Jim, that's what it is. That's what the volatility skew tool does. I use it for my calendar spreads. It has other uses, especially if you're interested in that kind of approach that you've found something where you've seen over time that you follow the volatility skew and you found that a smile or a skew in the volatility has worked in your favor for a specific strategy of what you're looking for. This is just an extra way to verify it on your stocks as well as your other criteria that you're finding on the search tool as well.